Let me tell you something strange. Banks don't just store money. They don't just lend money. They actually create money. Yes, out of nothing. Imagine walking into a bank. You ask for a loan. The bank doesn't go into a vault. It doesn't pull out cash. Instead, it types numbers into a screen, and suddenly, money appears in your account. New money that did not exist before. Sounds impossible, but this is how modern banking works. And once you see it, you will never look at money the same way again. Let's start simple. Imagine a village. There is only $1,000 in the entire village. That's all the money. Now imagine you deposit that $1,000 into a bank. The bank keeps a small part, let's say $100, and lends out the rest. Now someone else has $900. They spend it. That money ends up in another bank account. The bank sees another deposit. It keeps a small part and lends the rest again. This process repeats again and again and again. It's like copying the same money over and over, like making multiple shadows from one object. The original money is still there, but now more money exists in the system. This is called fractional reserve banking, but don't worry about the name. Just remember this: banks don't just move money, they multiply it. Now, here's where things get interesting. Modern banking works even differently. When you take a loan today, the bank creates the loan first, then the deposit appears. Let's break it down. You ask for a $10,000 loan. The bank approves it. They type it into your account. That money did not come from another customer. It was created in that moment, from nothing. Now you spend that money, buy a car, start a business. That money enters the economy. Loans create money, not the other way around. Now imagine millions of people taking loans. Each loan creates new money, so the money supply grows. But here's the catch. All this money is created as debt. Every dollar created is owed back with interest. Money is created as debt, and it must be repaid with more money. Where does the extra money come from? More loans. This is a cycle. Debt creates money. Money creates more debt. The system keeps expanding. What happens if people stop borrowing? The system slows down. Less money created, less spending, slower economy. Now, flip it. When borrowing increases, money increases, spending increases, the economy grows. Banks don't just lend money. They control how much money exists. Think about trust. This system only works if people believe. If trust breaks, the system shakes. That's why central banks exist. They manage interest rates. They try to keep the system balanced. Too much money creation leads to inflation. Too little leads to slowdown. It's like controlling water in a river. The entire financial system depends on balance. Banks don't just lend money, they create it through loans. Every time someone borrows, new money enters the system. It's how modern economies work. But understanding it changes everything. You understand why debt is everywhere, why inflation happens, because money is not fixed. It is created and controlled. If this video changed how you see money, subscribe to Capital Ledger, because once you understand the system, you start thinking beyond it.